relationship. So when an employer acquires a contract for insurance for its employees, the employer is going to be dealing with an insurer, just like an individual acquiring contracts for insurance is dealing with an insurer. The employer is what we call then the policy owner in the terms that we used with individual insurance, really the insured. So the policy owner or the employer actually enters into the contract. The contract then, we can plainly see, is a contract between the insurer and the employer. So they have this contractual relationship. The employees are not part of this contract. Again, as with individual insurance, this contract is a unilateral contract, meaning that the employer is not going to be held accountable, for example, for unpaid premiums. That would simply result in a lapse of coverage. The employees then, what happens here? Well, these folks are what we would call the plan members. Now, the employees have several advantages here. Notably, as a member of a group insurance plan, there's very limited underwriting. Generally, the way this works, the larger the group, the less underwriting we're going to have. So this limited underwriting means that if you're going to work for a very large employer with hundreds of employees, typically the only thing you're going to have to do to get covered is fill out the paperwork and start paying premiums. There is what we call the actively at work provision, which says that once you've done all the paperwork and we've facilitated the payment of premiums, the only thing you're going to have to do to get covered is show up at work. We're not going to cover somebody who is not healthy enough to actually show up at work. But that's a pretty simple bit of underwriting. The only time we do more underwriting with group insurance is when there are very specific needs. And this can happen when we have a very large amount of insurance sought, or when we have a small group acquiring insurance contracts. A group of less than, depending on the insurance company, 5 or maybe 10 employees may have to do some underwriting, although it's typically a lot less than what you'd face in an individual situation. You might also find that you have to do some underwriting when you're looking to acquire insurance beyond a certain dollar limit. Most insurers, when they're offering insurance as part of a group insurance contract, will insure somebody up to a non-evidence maximum. They'll insure somebody up to some limit beyond which they're going to need some underwriting. So they insure maybe for life insurance up to $100,000 of life insurance. They would call that their non-evidence maximum. And then without further medical evidence, that is without underwriting, you wouldn't be able to get more insurance than that. So we have fairly limited underwriting. We're also going to have a minimum level of participation. Now, going back to this idea that the insurer is in this business to make money, here's what has to happen. The insurer actually has to collect enough premiums to pay the benefits associated with the members of the group. If we allowed people to pick and choose their ability to join the plan, what you would most likely find is that the people who are not likely to use the plan would also be most likely to opt out. We would be left only covering the hardest to insure. However, because they're in a group insurance contract and there's no underwriting or limited underwriting. Even though they would be hard to insure in an individual situation, now the insurer is going to be stuck with them. Clearly, that's not a favorable arrangement. No insurer would do that business. No insurer would enter into an agreement where they know that everybody they're insuring is going to represent an unusual risk, a very high risk, and that we're going to have all the low-risk people opt out of the plan. So instead, what will happen is the insurer says, okay, employer, we'll happily insure your employees only if you can promise us that maybe 75% of them, which is a fairly common participation limit, only if you can promise us that 75% of them will stay in the plan. And the insurer knows that with a group of any kind of reasonable size, that once you have 75% of the plan members in the plan, or sorry, 75% of the employees in the plan, that now we have that reasonable level of participation. And it's likely that we have some high-risk folks, it's likely that we have some low-risk folks, and it's likely that we have some moderate-risk folks. That blend of different risk levels will allow the insurance company now to be able to calculate their premiums reasonably and have the plan members pay a reasonable cost for their participation in the plan or for their membership in the plan. So this is where we'd see this 75% minimum participation. What we're also going to see here is that the employees will not pay directly to the insurance company for their benefits. They're going to pay through a payroll contribution. Now, it's not necessarily the case that employees pay for any portion of the plan. Some employers pay the whole portion of a group insurance plan. So we could have this payroll contribution where the employees just see the money come right off their paycheck in the form of a source deduction, or we could have an employer who pays for the plan. Now, an employer cannot put a group insurance plan in place and have the employees pay 100%. The plan is really put in place for the benefit of the employer. Like I said at the beginning of the video, the employer puts the plan in place to help attract and retain quality employees. So the Income Tax Act actually says that if an employer is going to use a group insurance plan in the way that it's intended to be used, the employer has to pay at least 50% of the cost of the plan.